Netflix shares hit record highs this week as it revealed it had added 8.3 million subscribers in the fourth quarter of 2017 alone. The film and TV streaming service has more than 117 million customers worldwide and is worth an eye-watering £75.7 billion. But investors are asking whether the business can convert customers into cash and whether there are more gains to come. British investors can gain exposure to Netflix, which now spends billions on producing its own shows such as The Crown, by putting their money into a fund which tracks the S&P 500 stock market, such as the Fidelity Index US Fund, which has returned 128% over the past 5 years. Alternatively, they can back funds which focus on U.S. investments, such as Baillie Gifford American, which has 3.8% of its £980 million of assets in the stock. These firms have fundamentally changed the industries they operate in, forcing historical stalwarts out. Consider how Netflix replaced high street video rental firm Blockbuster. Despite the doubters, bulls say Netflix has the advantage of being the first mover in its field and a rapidly expanding customer base which will eventually bring profit. Lewis Grant, senior portfolio manager at Hermes, says, by traditional measurements, Netflix shares do look overvalued, but the traditional measurements don't apply to a company growing its revenue by 30% or more while reshaping an entire industry. But the likes of Simon Edelston, manager of the Midwind International Investment Trust, are cautious. He says, as far as we can tell, the current business model of Netflix is to spend $7 billion on programs and sell them for $6 billion of subscriptions. It seems to have no plan to break even, and this does not strike us as being a business model. Craig Bonthran, manager of the Cames Global Equity Fund, adds, Netflix has smashed it out of the park with its latest results, but its balance sheet is actually getting worse,